Hello, everyone. Welcome to UCLA Anderson and the third annual Fink Credit Pitch Competition. Thank you all for joining us. My name is Lori Santikin. I'm a professor of finance and strategy here in Anderson and the director of our Fink Center for Finance and Investments. We are delighted to share this exciting day of high-stakes competition with such a distinguished group from the business community. Aspiring investment managers from business schools around the country have traveled to UCLA to present their investment ideas, establish new bonds with one another, and learn from the seasoned professionals who form our bench of judges. It's a stimulating day that blends both camaraderie and rivalry in pursuit of the highest return. The first round of competition is now complete, and soon we will hear the judges' selection of teams for the final round. Incidentally, it's particularly fitting for this credit competition to take place against the backdrop of Los Angeles. UCLA Anderson is fortunate to be located in one of the global hubs of fixed income. Our neighbors include a thriving community of fixed income managers, many of whom we are proud to call our alumni. One such alumnus is Ron Mass, our keynote speaker for today. Ron is the founder of Almitas Capital. He was a senior portfolio manager for over 20 years at Western Asset Management and led the asset-backed securities and mortgage-backed securities portfolio management teams. Ron chaired the Leveraged Products Committee, was a senior member of the board of the Broad Market Strategy and Risk Management Committees, and was responsible for the management of over $100 billion in assets. Prior to joining Western Asset, Ron was a research associate at Credit Suisse First Boston. He is also a proud UCLA alum with a bachelor's in economics and business. Please join me in welcoming Ron Mass.
Thanks a lot, Lori, for inviting me, and I'm pleased to be here and welcome everyone from near and far. I'm actually a little surprised that I was asked to come here because I'm actually not a credit guy at all, not a corporate credit guy. In fact, my background is very different. My background's actually much more on collateral-based lending. But as Lori mentioned, I graduated from UCLA in 1987. I'm actually a third-generation Bruin. Both my wife and her parents and my grandmother went to UCLA. So we have a lot of love for UCLA and like to be involved. While I was at UCLA, actually, my interest in finance kind of was stirred on by joining what was called at that time Federal Home Loan Mortgage Corporation, or many of you might know it as Freddie Mac, as a summer intern between my junior and senior year. And so I started at Freddie Mac, and I walk in, and I noticed that all these underwriters had these big, really thick books, and I was wondering what they were doing, like paging through these thick books, and they were paging through and looking at amortization tables. And so here I'm this kid from UCLA, and I just gone to the student store and bought this new, really powerful calculator. I don't know if any of you guys have ever heard about it. It's called the HP-12C. Anyone ever hear about it? So the HP-12C does some amazing things, like add, subtract, multiply, divide, take square root, squares, but it also calculates amortization. So I go up to the underwriters and I say, you've got these books, there's this calculator called HP-12C, and it can actually calculate amortization for you. Like you put in a few things and it tells you the amortization. You don't need that big fat book. So here I am, they thought I must be this whiz kid. So like within a couple weeks, every underwriter had an HP-12C. And I was sitting down with all these people that were 20, 30 years older than me, teaching them how to use that. So they thought, wow, this kid's a genius. So anyway, that kind of got things started. So then I interviewed with First Boston and had told them that I was I'd worked at Freddie Mac, and they were like, oh wow, okay, that's great. So I'd gotten a job, and they figured they'd place me in the asset-backed and mortgage-backed securities area. Since, of course, working at Freddie Mac as a summer intern, I must have known everything about mortgages. I'm at First Boston, and then the second year I'm there, a bunch of people from our department all leave, and they leave to start this new firm. And this firm, so we jokingly called the firm Second Boston because they had all left. So Second Boston goes on to hire a bunch of people from First Boston in New York. And I don't know if you have ever heard of this firm. or the people from it. Second Boston in New York is the nickname. Okay, well, let me give you some clues. There's an investment center at a major U.S. MBA program that bears this person's last name. And this person's married to a woman named Lori, and his last name rhymes with drink. I don't know, does that help at all? Maybe Larry Fink. And the company's name was BlackRock. So BlackRock started in 1988 from a bunch of people that left First Boston. And they actually started in bank and thrift advisory. But it turned out that I don't think was that profitable and actually a hard business to get into. And the companies were losing a lot of money, so it kind of wasn't the most profitable thing to do. So they decided to do asset management and start managing mutual funds and closed-end funds. And I think in hindsight, that worked a little better for them, given that they're the largest money manager now in the world. So anyway, now you know a little bit about the history of BlackRock and Larry Fink and how he started his career after graduating UCLA MBA at First Boston. Anyway, so basically, and after my 4 years at First Boston, I was looking always for a way to get back home to California. I'm a Southern California native. And so I heard about this company, Western Asset Management, and they were looking for someone to do asset backs and mortgage backs, which were pretty new at the time. So I started there, and then sure enough, basically started running the group there. The way I think about my philosophy in terms of investing is basically this company that was across the street from our building basically had money to loan, and we had money to loan too. And so they would loan based on people's guitars and jewelry and gold watches. And so we would basically do the same thing. But we just lent on residential homes, commercial real estate, airplanes, autos, credit cards, manufactured housing, anything like that. Anything that had value, we would lend on. So very much just like the Crown City pawn shop, I always considered ourselves a professional pawn shop because we were actually our old building at Western Asset was located right across the street from the Crown City pawn shop. That's Western Asset's building, so a little bit bigger than the pawn shop, but same idea. Anyway, just I think Lori already introduced me, so I'll skip over the bio part. I was always intrigued by asset-backed securities, understanding the probabilities of default and prepayments and all that kind of stuff. So now I'm here speaking with you, and I'm actually a little bit nervous because Suzanne Tripp, who's actually a high-yield analyst from Western Asset, she's in the audience. So she knows high yield much better than I'll ever know it. I went to committees with a bunch of high yield people and investment grade folks, so I figure I know enough to wing it here. The way I think about debt versus equity investing. So debt investors, we're pessimists. We're always worried about what's going to happen. When you're an equity investor, you're an optimist. You play offense. We're playing defense. When you're an equity investor, you've got unlimited upside. You own the call options. We're basically short call options. We have no upside. If we do the best we can do, we get the coupon and we get our principal back. So we're actually short, deep out of the money put options on the equity effectively. If you're an equity investor, you're long volatility. We're short volatility. And if you're an equity investor, you're trying to make, say, 7 to 10% a year. We're happy if we can make 2% over treasuries per year. And if you're an equity investor, growth is really exciting. If you're a bond investor, sometimes growth is pretty scary because we like companies with lots of stable cash flow. We don't want growth. We don't want negative cash flow. We don't want huge CapEx. We want stability. So I'm not sure if I've scared any of you away from a credit pitch and you want to do a stock pitch next, but sorry if I did that. I thought it'd be helpful just to talk about defaults, and I'm sure all of you know about credit ratings and how AA bonds are safer than single A's, and CCC bonds are the lowest rated and the riskiest. And here we have the cumulative defaults over time. This is based on Moody's studies. So this is the historical cumulative defaults of different rating grades of bonds. So this would take a AA bond and take a bond that started as a AA and show its historical defaults over its life. What's clear here is that the lower the rating, the higher defaults. But what's also interesting on the next page is the annual default rate by credit grading really starts out very differently. I imagine a lot of you are familiar with this, but CCC bonds have a very front-loaded default curve. So the low-rated bonds default at very high rates early on, and the high-rated bonds default at low rates. But what's interesting is over time they converge. So if your CCC bond makes it for 5 or 10 years, the actual historical default rate for CCC bonds that make it past 10 years is very low. Same with single Bs. So what's that mean? If we look at the annualized default ratings over time, so here we have the default rates on the left by rating category for the first 5 years, then the default rates for the next 5 years, then the next 5 years from 11 to 15 years, and finally from years 16 to 20. What's interesting is years 16 to 20, everything looks about the same. So if a CCC company has survived for out to 15 years, there's a good probability it's not a CCC anymore. It probably got bought by a nice investment grade company, or it delevered, or something happened that made that much better. Conversely, a lot of the higher rated bonds might have decided to change their capital structure, and now they're high yield bonds. So what's interesting, what I've always believed is you want to have the upside of being able to stay out there for year 5 to 6 to 10, years 11 to 15, and years 16 to 20. Now the problem that bond investors have is that issuers want to call the bonds. If things go well, they want to take your money and refinance you and issue at much lower rates. So the issuer call option effectively limits the investor's upside. And so most high yield debt is issued as callable debt. 10-year non-call 5, 7-year non-call 3, 5-year non-call 2. Whereas most investment grade debt is non-callable. But as an investor, we actually want the opposite. Think about that CCC bond. The first 5 years is incredibly risky, but the next 5 years, the risk is much lower. So the fact that they're going to take it away from you, that they're going to issue a 10-year non-call 5 and take it away from you just at the very time the default rates are coming down, that's no fun. I'd like to, I'm buying that bond to get the next 5 years, to get the period where the default rates are much lower, because again, that bond's likely to be upgraded, but the issuer is looking to try and call it to save their interest costs. So what can you do about that as an investor? Well, one easy thing is to buy discount dollar price bonds where you have the upside, so the call doesn't matter as much. Another is to buy fallen angels, which are those bonds that used to be investment grade. And I've probably heard a lot about how everyone's worried that that BBB bucket is such a large part of the index these days, and if that got downgraded, it would overwhelm the high yield market. But certainly, a lot of the former investment grade or originally issued investment grade bonds have good call protection. And certainly the lower dollar price securities help to balance out that downside you have with some upside. Another way to look at it in terms of opportunities are actually convertible bonds. And I used to manage our convertible bond area because I just like things with options and things that are complex. And a lot of convertible bonds that originally had equity value, once that equity option isn't worth much, they call them busted converts. And a lot of convertible bond people like to sell them because they don't fit their profile anymore. So often they trade as cheap or cheaper than the bonds that aren't convertible. And because they were originally issued with very low coupons, those often trade at big discounts. So they often give you the upside. As long as all things being equal, as long as they're pari passu, some convertible bonds are issued with lower ratings or as sub-debt. So let's talk about some of the risks to corporate bondholders. Again, as an equity holder, we love innovation. We don't like innovation as corporate bondholders. Just think about all the disruption that's happening today. Internet and technology. Just think about all these industries, the media industry, print or television. We've all heard a lot about retailers, even real estate. Anyone interested in parking lots? I'm not sure I'd want to make a 30-year loan on downtown LA parking lots, not knowing if you're going to have autonomous cars and who's going to want to pay $40 per day to park downtown if you can just have an autonomous vehicle drop you off there. Certainly renewable energies, who knows what we'll have there with the cost of solar and wind coming down versus traditional fossil fuels. Shale drilling technology certainly changed the cost of production. Offshore, I'm not sure I'd want to be an offshore deep water drilling company right now. And then also, even companies, the helicopter industry that services the offshore drilling, those companies are in deep distress right now. A lot of people don't need those, unless the offshore drilling comes back, we might not need those. Maybe we'll turn them all into air ambulances, which is also a good industry. Then there's clearly the business cycle risks. As Sam Zell says, whenever a developer can develop, they're going to develop. And as soon as prices exceed the replacement cost, you'll see a lot more real estate going up. So businesses like to develop, they like to expand, they like to grow. So that often happens to, in excess when the economy is going well. Certainly we've seen that over time with hotels or office buildings or even multifamily in the real estate side. And certainly when commodity prices boom, we start figuring out new ways to produce. And that's part of what happened with shale is, prices went up so much, it made sense to invest so much into shale. And then gradually the prices came down, and now if you're deep water drilling or if you're another type of technology that's much more costly, as the costs have come down, you're in trouble. So let's talk about what's so great, asset-backed securities. So forget all this corporate stuff that you guys are doing. You don't want to be doing that. You want to do asset-backed and mortgage-backed securities. That's what I really love. See, I had to sneak that in. Anyway, so what's so great about asset-backed securities? Well, they're bankruptcy remote, so we don't have to worry as much when a company goes bankrupt. We don't have to worry that we're going to be caught up in the bankruptcy. That generally holds true if they're structured in specially purpose vehicles. We know our collateral, so we know what we have. Usually if they're packages of loans, we can follow those loans and we can track every month how they're doing so we can see the performance of them. And they tend to deleverage over time. Usually the amortization schedules or the way the loans pay down is faster than the way the assets go down in value. And sometimes we even have assets that go up in value, like theoretically commercial real estate and residential. The cons are against asset backs is we don't have that corporate guarantee. So it could be that the company's doing great and we just bought that terrible vintage that's underperforming, kind of like the 2006 and 7 vintage subprime. Although most of the companies that originated those didn't end up doing so hot either. You've got certainly potential conflicts of interest because the equity holders or the sponsors sometimes have already sold all their interest in it. They have no skin in the game, or maybe they own the subordinate piece and they want to do what helps to maximize their value, and we can talk about that. We'll talk about that a little bit later. And there's also the prepayment or refinancing risk. Unlike corporates, which are generally bullets or scheduled amortization, we don't have that. With the asset backs tend to be much more variable. So my favorite is actually secured corporate credit, where you're protected by the value of the collateral, you've got the corporate guarantee, and generally you have a greater alignment of interest. Those are the types of securities I've actually always liked the most, because you tend to have it's nice to have that alignment of interest. However, it doesn't always work perfectly in terms of the line of interest. One example I wanted to point out, which did work out well, and actually Suzanne was very involved in, on the unsecured side and also the secured side. We used to all work together as team members and all the different groups. Even Suzanne and I worked closely together. But after 9/11, 2001, the airline industry was in severe distress. So at Western, we bought billions of airline bonds. The bad news is almost every airline we bought, American, Delta, Northwest, United, US Air, they all filed Chapter 11, so that wasn't so good. But the good news was that we had collateral. So we were lending to the airline, but we also were lending to collateral, based on collateral. So if you have good collateral, so you're a secured financer, and you have good collateral, and that company wants that collateral, they might keep paying you. And that's what happened, even though all these airlines went bankrupt, they decided that they wanted to keep flying these planes. And fortunately, the structure of these securities is pretty sound, where you have what's called Section 1110 of the Bankruptcy Code requires airlines to either reject the lease within 60 days of bankruptcy and return the aircraft, or keep paying and keep the aircraft. So if the airline wants, if you have good planes that the airline needs, one thing that kind of helped us was it helps for airlines to have planes to fly. Because if they reject their leases and then all of a sudden they don't have it's a little hard to shut your business down for 6 months, reject your planes, and then wait for Boeing to produce new ones. So they really didn't have much of a choice if they wanted to keep their schedule. So as long as we thought that they were going to be a Chapter 11 reorganization and not a liquidation, we were in good shape. But anyway, what this tells me, what reminds me as far as a lesson is you want to have good collateral, a good structure, and you want to have that alignment of interest with the issuer. I don't know if any of you know Where's Waldo, but I kind of took this a little bit from Where's Waldo. Where's my collateral? So you have to make sure that your collateral is actually really secure. And sometimes equity sponsors or the owners of the companies are pretty good at figuring out how to get your collateral and how to maybe take it from you if you're not careful. Some of the risks that I've seen in my career and things to be aware of are, is your collateral properly assigned and recorded? Do you have the collateral you think you have? One interesting example to point out is Molycorp. Molycorp was a company where the first lien bondholders thought they were in really good shape. They had the mines. That's what made Molycorp, that was the main thing, right? If you're taking a mining company and you have the mines as collateral, you're in really good shape, right? One problem, they forgot to secure the equipment that was in the mines. So then Molycorp went, and there was an astute investor who worked with them who did a large loan during their distress at high interest rates, secured by all the equipment in the mines. So then all of a sudden the first lien holders were basically alerted to the fact, you own the mines, that's great, but if you don't pay this other holder or treat them as pari passu or senior to them, we're going to take all the equipment out of your mines, and you're just going to have a big hole in the ground. So I think you got to be careful. That's just one example of how important it is to know if you've got your credit. If you really have assigned and recorded the property, the deeds properly. In terms of indentures, how tight are the indentures written? Are there risks that someone could get a little sneaky there? Do you trust your equity sponsor, especially when times get tough? When times are good, everyone's nice, but I remember plenty of phone calls that I'd have where I'd call in with the issuer when they wanted to issue the paper and sell their bonds. They were really friendly. Investor relations was there. I could talk to whoever I wanted. As soon as they hit distress, sorry, not available. Just no return phone calls. So always just keep that in mind. And also, could your collateral position become jeopardized in bankruptcy? Could you end up, a dip financing, end up taking your secured collateral and make a loan that's effectively senior to you, which often happens in bankruptcy. I think it's helpful to pick some examples of things that maybe went wrong. I don't know how many of you are familiar with Caesars Entertainment Operating Committee, or company, but Caesars was known as Harrah's, and it was a very successful casino business. And in 2007, there was an LBO where the equity sponsors, Apollo and TPG, took it private. Of course, 2007 was right before 2008, before the financial crisis. And maybe some of us remember how Obama said it's not really politically correct to be hanging out and having conferences in Las Vegas while the whole nation's in crisis. So Vegas wasn't exactly doing so hot in 2008 and 9. Well, Apollo and TPG, so they created some new subsidiaries, and they started getting kind of creative. And private equity sponsors are pretty smart guys. They're pretty clever in terms of lawyers and structurers and bankers. So they decided to start transferring some assets out. So there was this thing, kind of an obscure company called World Series of Poker Tournaments. I don't know, has anyone heard of that? Probably kind of worthless asset, right? So I think for $10 million in consideration, they transferred that out, kind of transferred that into the parent entity. There was this rewards program that actually made Harrah's and Caesars famous called Total Rewards, the affinity programs. That a lot of gamblers would, they liked this affinity program so much that they would gamble much more. Well, that was a worthless asset, so they kind of transferred that out. And then there were some casinos that weren't really valuable, like their prime casinos. So they sold those out at some pretty low prices and transferred those into some new ventures. And also the parent had guaranteed the operating company debt, where basically the operating company entity where most of the debt was. Well, they decided to relinquish that guarantee. Parent company doesn't need to do that. And who owns basically the parent company equity? Apollo and TPG. Okay, so now we don't have our corporate guarantee and we just lost a bunch of our assets. Well, so I guess it's not surprising the company went bankrupt. And when they went bankrupt, there wasn't much left for the bondholders. So as often happens in a complex bankruptcy, they hire a bankruptcy examiner. So the bankruptcy examiner noted a few things. Noted that insolvency can be measured 3 ways for a company: by balance sheet solvency, cash flow solvency, and capital adequacy solvency. Interestingly enough, Caesars operating entity failed all 3 of these tests at the time, before and after, they were actually stripping all these assets out. So what do you call that? I think that's called a fraudulent conveyance. So the bankruptcy examiner kind of raised some questions about that. When you're a bondholder, sometimes it's a little tough to exercise your rights. But fortunately, there were a lot of bondholders that were unhappy, and they were able to convince with the bankruptcy court and the examiner that Apollo and TPG should contribute some of their equity back into the bankruptcy from the parent company, the holdco. Otherwise, you would have had a situation where the equity would have actually done much better than the debt, which we're not used to. We're thinking capital structures. Debt always does better than equity, right? Well, not if you pull all these assets out. What's interesting is there's this public company called MGM that was also in a similar crisis, but they were public. They didn't really transfer any assets around because it was one public entity. And they actually ended up coming out of this, and the bonds traded all the way back up. But the outcome wasn't quite so good for Caesars Entertainment Operating Company. Anyway, so just not to scare you off too much, but just some points of what can go wrong. Well, if I haven't shown you too much, let's talk about more bad behavior. But anyway, stripping out of collateral is becoming increasingly common in debt structures. You've had Neiman Marcus, PetSmart, Chewy, which was a very profitable and a new, exciting entity that they tried to spin off or spun part off. J. Crew spun off their intellectual property. You've had companies borrow on their revolving lines of credit and then divvy out money to the sponsors. That certainly happened. So you have a lot of situations, you can have a lot of bad behavior, and when things turn south, there's a great potential for equity sponsors to want to do this. And now when you think about so many loans are covenant light and don't have the protections, it's so much easier for companies to do this. So of course, that's why asset-backed securities are so much better than debt. So have I convinced you? No. Okay, let's talk about asset-backs for a second. Asset-backs actually aren't perfect themselves. And the reason I'm saying this is, just thinking about the speed bumps or pitfalls I've seen in my years, and hopefully by looking and thinking about some of these, it'll help you in your careers to avoid some of these. So risk retention is this idea that the originator has skin in the game. Well, what happened in the 2000s was, and we've seen this many times before in the asset-backed market, when the rating agencies are really maybe too aggressive in rating, or you get these new structures called like CDOs and CBOs and CLOs that people want for ratings and for yield, and we get greedy, you often underwriting standards slip. So, you have this case where a lot of companies started saying, well, wow, we could originate and we don't have to own anything. We're originating these loans at 100 and we're selling them off at 104. Who cares what we're originating? Because who cares? We're making 4 points. As long as we can get the other guy to buy it, we don't care. How would they have acted differently if they had to eat their own cooking? If they actually had to keep that on their balance sheet? And it's amazing how much better companies' debt performs in the asset-backed world when they actually have to keep it and own the bottom pieces. However, even when they own the bottom pieces, if they're servicing the debt and things start to go awry, sometimes they might take actions to try and preserve their interests. I've seen a number of companies over time, they own the subordinate interest, you own the senior interest. If they foreclose on loans or repossess autos or take back collateral and recognize losses, that wipes out their piece. They don't want that. So what do? They just stop foreclosing. And then everything's fine. There's no triggers, nothing's failing. We're not writing down our own piece. We get all the cash flow. We actually don't even have to do anything. We don't even have to service these things. We don't even have to have these servicing people. Our costs go down, everything's fantastic. So that's happened a number of times out there, and that can be a little scary. Either that or the servicer realizes, geez, this isn't working out so well. Why don't I start charging a bunch more fees? So they start charging borrowers lots of late fees, all kinds of penalty interest, everything, and they collect all that. Well, if you start making life so difficult for your borrower, they're not going to pay off their loan, and they're going to default at a higher rate. So we've seen that kind of behavior also. So just something to be careful about. And then to top it off, in the commercial mortgage market, we had a lot of deals would allow servicers to buy out the loans at fair value. Who determines fair value? The servicer determines fair value. So what do? You buy out the loan, and you stick it in one of your subsidiaries, and you have the subsidiary sell the loan. Miraculously, some of those loans have been sold at pretty big profits, but they were taken out of the deal at fair value. So that works out pretty well. That makes servicing a lot more profitable. So anyway, again, most things turn out great in life, but having done this for 25 plus years, I've seen a few that haven't quite gone so well. But those are some of the things to keep an eye out for. Something else I might say to keep an eye out for, I don't know if you've heard the expression, the fox guarding the hen house. So here we have kind of the hen house, and those are bondholders. We have the private equity sponsor, not to pick too much on private equity sponsors, but a lot of bad behavior tends to happen with private equity sponsors. And then we've got the corporate directors who are really watching over us. And so corporate directors, what you love to have is independent directors who are really exercising their fiduciary duty to bondholders. And in a lot of ways, public companies are superior to private companies where you have a majority of independent directors on the board. And hopefully they exercise their independent fiduciary duty. However, just corporate governance, just some things to think about in corporate governance. When you have, especially some of these private equity entities, like you had with Caesars, where you have separate subsidiaries and management owns one subsidiary and bondholders own another, you really need someone watching over transactions that happen between one subsidiary or another. If we're going to pull assets out of a subsidiary, we probably should have some directors take a look at it, and those directors probably shouldn't be the ones of the equity sponsor, and they probably shouldn't be the same directors of the entity that's going to be selling assets as the entity that's going to be buying assets. But that's actually what happened, not to pick on the Caesars example, but that's actually one of the problems with Caesars, is they didn't have different directors at each of the subsidiaries. So the directors that basically were interested, the interested Apollo directors thought it was a great idea to buy World Series of Poker tournament for $10 million when other people said it was worth $100 million at the time. $10 million sounds like a pretty good deal. Also, another thing is, are your independent directors always independent? And what's interesting, in the UK, their corporate governance is a lot better than our corporate governance in many ways. In the US, you can be an independent director of as many companies as you want. In the UK, they generally frown on independent directors that are with more than just a few companies. You can also be an independent director of many entities of the same company, whereas they frown on that in the UK. Think about just some simple examples like Franklin Templeton, hopefully there's no one from Franklin Templeton here, or Eaton Vance, or just any of the big mutual fund companies. A lot of them have like closed-end mutual funds. And a lot of them have the same independent directors on many of the funds. In fact, there's some independent directors that are independent directors on 100 different funds. Now, they only get paid maybe as little as $3,000 per fund. But if you're on 100 boards of the same entity and you're making $3,000, I'm on some boards and I love getting free donuts and coffee. But if I got $300,000, I wonder if that would change my behavior. Like if I'm getting $300,000 a year by being an independent director for this management, from this fund management company, what if I start saying, geez, my fiduciary duties to all the equity holders of the funds, not to management, and I don't really like what you're doing. So I think you guys should change the way you're doing stuff. You might not be on that board anymore. So what I'd always ask you to consider is, what are the incentives of the independent directors and how truly independent are they, given that a lot of them are appointed by effectively the managements that they report to. And the US, that can be a pretty serious problem. The other thing I'd leave you with in terms of valuations and when assets are moved around or companies sell or buy assets are fairness opinions and fair value. In a lot of cases, and we'll use the Caesars as an example, why not? Because that was an easy one, because there's so many things that went on in that. But you had the investment banks giving the fairness opinions. Those were the same investment banks that, so if I come to an investment bank and I say, geez, I'm interested in buying this entity, I'm interested in buying World Series of Poker out of the subsidiary. And I'd like to buy it at what do you think, a high price should I pay or a low price? Well, usually if you're buying it, you want to buy it at a low price. Well, if the investment bank knows that they're going to be paid a fee contingent upon the success of the transaction, I think they're probably smart enough to figure out that if they assign a really high value to that transaction, it's less likely to occur. If they assign a low value to that transaction, it's more likely to occur, and they'll have better success and they'll earn their fees. So I would just say, who is giving you your fairness opinions, and do you believe those fairness opinions are truly independent? And again, I hope I haven't scared you all off and now you want to be equity analysts or don't want to be investment management. Because again, to start, the BBB securities I was talking about, after 5 years, only 1.5% of them default. Even double Bs and single Bs, triple Cs, the majority perform, especially over a long period of time. But I just want to leave you with some of the things that can possibly go wrong. Anyway, I wish you the best of luck with the competition this afternoon and in your careers. And please, hopefully, think about these considerations. Don't get discouraged, but always have them in your back of your mind as you're reviewing transactions and reviewing documents. think we probably have about 1 minute. I don't know if there's one or two questions, but otherwise, I think if there's any questions, I'm happy to. Sure.
Ron, how difficult is it to find a good law firm to make sure that they understand and can incorporate all of this into your documentation?
Well, the good news is law firms do have to perform conflict of interest checks. So if they are dealing with the other side, they're going to have to let you know, and they can't take your business. So I think if you find a reputable law firm that knows the subject matter, I think you're in pretty good shape. What I'd say, it's always worth paying a little more for the lawyer that's the expert rather than the lawyer who's going to help you out by doing research. And I've had occasions where I've called up lawyers or talked to lawyers and say, we don't know that, but we're happy to do research on it and get back to you. That's the last thing I want to hear. I'd rather pay someone much more and not have them go to the library and research it. I want the guy who knows the answer and can tell it to you in a half hour because he's dealt with that situation before is worth a lot more. Even if his rates are 1.5 times the other guy, I'd still rather pay him the fee rather than have someone learn at my expense.
What can we do to stop these directors from being just like a puppet of the CEO? And whenever they get an independent guy, he's booted out after a few weeks, months, or whatever.
It's an issue, and I think it's something that we need to carefully think about how we want to allow independent directors to be hired. So a lot of companies have very strict thresholds. I guess I'm a director of some companies, so of course I'm going to say good things about them. But it is a concern that you can be a director on so many companies, or that you can make so much money from being a director that might influence your decision. I'd almost look at how wealthy your directors are, and I think I'd rather have directors that have a lot of independent wealth and are doing it because they want to do it, not because they really want to get paid. But I hope that someday we look more at the UK example, which they have much stricter. Our standards are pretty good, but UK and other countries actually have much stricter thresholds. There are laws, and independent directors are supposed to be independent, but it's hard to govern their exact behavior. It's hard to know how closely aligned or how much potential conflict of interest an independent director might have.
It's more relevant to have docs that are really strong in terms of the wording and the way they're written, or it's more the trust and the people behind, for example, a private equity transaction that makes you more comfortable with that?
That's a tough. I think you need both, really. I think what you want to do, especially with the entity on the other side of the table, is I think the way I like to look at someone as far as the trust is I like to look at, before I even meet them, I want to have a view of whether I'm going to trust them or not. So I want to look at their background and the history of their transactions. Were they just at a company where they did some questionable things, or have they had a long history of doing reputable things? And then I want to meet them in person. And sometimes you just get that feel. And sometimes you're right and sometimes you're wrong. But I think if you look at people's actions and their history, I'd say that's important. I think, if you have a public company, I think you've got a better chance in general than a private sponsor. But then also I'd say spend your money and spend your time and try and have docs as tight as possible to prevent a lot of the activity that's going on, the bad behavior out there. I think I'm a little bit over my time. So anyway, thanks again, and good luck with your careers and the rest of today.
Good afternoon, everyone. I'm Jim Park, a first-year director of credit pitch competition. So before announcing the round one winners, I would like to give thanks to Mr. Ronald, founder and CIO of Almitas Capital, for sharing his unique insight throughout the keynote speech.
Thank you. Thanks a lot. Thank you.